However, Europe's stereotypically high tax rates have turned many successful entrepreneurs and investors away from the idea in search of zero-tax countries in the Caribbean, Middle East, or the Pacific Ocean. While living in Europe and living in one of the countries with the lowest taxes is a rare feat, it is possible for almost anyone to live in Europe full-time and pay low taxes on their income, even if they're not a millionaire. However, before we begin our countdown, we would greatly appreciate it if you would subscribe to our YouTube channel and also press the bell icon. Let's get started. Number 1. Andorra. Pressure from the European Union caused Andorra to implement its first-ever income tax in 2015. But Andorra still remains a low-tax haven conveniently nestled between high-tax Spain and France. Long known as a destination for duty-free shopping, Andorra is an idyllic mountainous country that also happens to offer residence permits to investors and business owners. Fortunately, Andorra has positioned itself to attract those of more average means than other low-tax countries like Monaco. The only tax is an income tax, of which a generous 24,000 euros is exempt, and the top rate of 10% takes effect at the 40,000 euro level. Number 2. Bulgaria. At a flat 10%, Bulgaria has the European Union's lowest personal income tax rate. Corporate income tax rates are the same flat rate of 10%, tied with Cyprus, and Bulgaria maintains tax treaties with many countries that could allow for special tax treatment for some international entrepreneurs. The payroll taxes are capped at 19.6%. Basically, Bulgaria's tax system is simple. Live there and pay taxes at only a 10% rate. You can become a fiscal resident by living in Bulgaria for at least 183 days in a year, or by convincing the tax office that Bulgaria is your center of life. Number 3. Czech Republic. The Czech Republic is often ignored as a low-tax jurisdiction, despite the fact that it has streamlined both personal income tax rates and corporate tax rates to reasonable levels. Considering that Prague is one of the most cooed-over cities in Europe, the idea of living in the Czech Republic is worth considering. As a low-tax residency, the Czech Republic, or Czechia, as they prefer, is best suited for European Union citizens. That's because self-employed Europeans can not only avail themselves of Czechia's 15% flat tax rate, but may also apply a lump sum tax deduction in lieu of actual expenses. For most business owners, the lump sum can reduce the flat tax by 40% or 60%, leaving an effective tax rate of 6% to 9% on self-employed entrepreneurs. Number 4. Georgia. While Georgia may not be in the center of Europe, its position in the Caucasus places it squarely between Eastern Europe and Asia. Fun fact: Georgia also happens to be the only European country with a largely territorial tax system, meaning properly structured foreign source income is not taxed in most circumstances. While this is no stranger to the Gulf Tiger Dubai that only levies state income tax with no foreign-sourced income, that's almost never the case in Europe. Georgia's income tax is set at 1% for individuals with an annual income of up to 500,000 Georgian lari, GEL, which is about $164,000 US, with 0% personal income tax on foreign-sourced income. Number 5. Gibraltar. Gibraltar has long been a popular tax residence for British citizens, but Gibraltar's benefits as a low-tax residence are available to anyone. Nestled at the southern tip of Spain, Gibraltar is a British overseas territory and not a sovereign country, but is able to set its own tax policies. There are 2 ways to become a resident in Gibraltar: start a company or demonstrate a high net worth. You must earn more than £120,000 per year, but will only be taxed on £120,000. That essentially translates to a flat tax of £29,940, although you must also consider any Gibraltar corporate tax. You will need to own or lease a home in Gibraltar. Number 6. Malta. Malta is one of only 4 countries on this list that are part of the Schengen area, and one of only 3 that are also part of the European Union. The island nation has developed some of the EU's most tax-friendly programs for both individual residents and corporations, with corporate tax rates as low as 5% possible for non-resident companies. Malta has long had a flat-fee residence program available. Unlike Andorra and Monaco, Malta does not require any physical presence on its 2 Mediterranean islands. Number 7. Monaco. While Monaco is not a full member of the European Union, it is a de facto participant in the borderless Schengen area, offering excellent mobility. Monaco's exclusivity and proximity to France and the rest of Europe make it a more serious tax residency than some tiny island in the middle of the ocean. According to the tiny principality, it is not a tax haven. It does allow foreigners to establish residence in Monaco merely by proving their wealth. Monaco's personal income tax still stands at a 0% tax rate, while its corporate income taxes are now set at 25% since the start of January of 2022. Number 8. Montenegro. Montenegro boasts about being one of the lowest personal income tax and corporate income tax rates in Europe, both pegged at a flat 9% for 2022. Like many of its Western Balkan neighbors, Montenegro has sought to attract business to its small country of population of 620,000 by lowering tax rates. While almost all of Eastern Europe offers rather reasonable tax rates in the teens, Montenegro offers the lowest tax rates and the benefit of a country you might actually want to live in. Number 9. Portugal. Portugal is a high-tax country. Foreigners can take advantage of a 10-year non-habitual resident tax exemption that exempts up to 100% of their income from Portuguese tax. Most people don't associate Portugal with low-tax countries. In most cases, they're right. Portugal is hardly a tax rate favorable place for the average resident. The country's tax revenue, percent GDP, stands at 23.4% in March 2022 compared to Switzerland's latest 9.2%. However, foreigners can take advantage of a 10-year non-habitual resident tax exemption that exempts up to 100% of their income from Portuguese tax. Number 10. Switzerland. Switzerland was one of the first countries to allow wealthy taxpayers to negotiate a flat annual tax with its cantons at a maximum of 11.5%. There is no doubt that Switzerland has become less friendly both for immigration and banking in recent years. That said, it is still one of the safest and most respected countries in the world, with a location at the heart of Europe. Swiss residency offers an air of legitimacy that many other low-tax residencies can't match. Foreigners have 2 residency options to choose from. The first is to form a new company in Switzerland and hire local employees. This company will pay corporate income tax based on which canton, region it is incorporated in, and you as the manager will pay Swiss income tax. The more common and lower tax method to living in Switzerland is the lump sum taxation method, also known as taxation according to expenditure. Under this method, a family may move to Switzerland and pay a flat annual tax based on their cost of living rather than their actual income. So that's it for today. If you find this video helpful, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching and see you next time.